Okay, let's just put the number on the table
Right.
right away, because it's really the only thing anyone is talking about today.
It's everywhere.
It is. In the traditional financial world, in crypto,
Yeah.
everyone. It's Wednesday, February 11th, 2026. And that number is $40 billion.
It is a staggering figure.
Yeah.
Really
I
is.
mean, that's the valuation that's currently attached to Ripple as they're gearing up for, well, what looks like an imminent initial public offering. And 40 billion. That's not just a good job number.
No, no.
That is we are a titan of industry kind of number. It's bigger than what a lot of legacy financial institutions are even worth.
It puts them in a very rarefied air. We're not just talking about a unicorn anymore. I mean, in the startup world, you hit $1 billion, you get the horn.
Right.
10 billion, maybe you're a decacorn, but 40 billion. At that point, you are establishing yourself as a piece of the global financial infrastructure.
Exactly. And, for anyone listening who's been in the crypto space for, say, the last 10 years, this moment, it feels heavy. It feels a bit like vindication. The XRP army, the
Right.
long-term holders, the people who stuck it out through lawsuits, regulatory winters, they're looking at that 40 billion and thinking, finally, we were right.
And look, emotionally, they're right to feel that way. It's a huge validation of the company's, survival instincts. But, and this is really the whole mission of our deep dive today, we have to separate that emotion from the financial mechanics.
Yeah.
We really need to look at what that valuation actually means, because there's a very dangerous assumption floating around right now.
Which is, if the mothership is worth 40 billion, then the lifeboats have to be made of pure gold.
Precisely. The assumption is that a booming company valuation automatically means a booming token price. It seems so logical on the surface, right? If Ripple the company is crushing it, then XRP the token. It should be skyrocketing.
But the stuff we're looking at today, data from CB Insights, market analysis, reports on investor psychology, it all suggests that relationship is nowhere near as simple as people hope.
Not at all.
So let's be the skeptics today. Let's poke a few holes in the champagne bubbles. We have to start with the valuation itself. $40 billion. Where does a number like that even come from? Is it just because they're sitting on a huge pile of XRP?
And that's the first misconception we need to clear up, because if this valuation were just based on their crypto holdings, it would swing wildly every single day.
Right.
No, this $40 billion comes from the business fundamentals. CB Insights notes this valuation is driven by Ripple, and I'm quoting here, expanding its footprint with banking giants.
Banking giants. That's the phrase that jumps out. We're not talking about some obscure crypto exchanges anymore. This is the plumbing of the global economy.
Right. I mean, think about what Ripple actually sells. They sell software, liquidity solutions. They sell the ability to move money across a border without waiting 3 days for a wire to clear.
So when an investor's looking at Ripple for an IPO, they're looking at contracts, recurring revenue from these banks.
Yes. They're valuing Ripple as a fintech SaaS company, software as a service.
Okay, let's just pause on that because that is such a crucial distinction.
Yeah.
You're saying the Wall Street guys, the ones actually doing this valuation, they're looking at Ripple the same way they look at, say, Salesforce or Stripe.
Exactly.
It's about the cash flow from the software deals.
They're valuing the factory, not the product coming off the conveyor belt. And this is where that disconnect starts to form. You have these huge banking partnerships. The banks, they love the software because it's efficient, but here's the big question. Do those banks need to hold the token to use the software?
And that's the classic debate, isn't it?
Yeah.
And the answer is usually not always.
Exactly right. So much of Ripple's tech can just function as a messaging layer, a settlement layer, that doesn't necessarily require the bank to hold a volatile asset on its balance sheet. So you can get the situation where Ripple, the company, is making money hand over fist selling tech.
You're justifying that $40 billion tag.
Right. Well, the token itself is just kind of watching from the sidelines.
Right. Which brings us to the community's response. Because if you look on X or Reddit right now, the nuance you just laid out, it is completely missing.
Oh, it is hype central out there.
Hype is putting it mildly. The source material we have describes the atmosphere as people rushing to social media. It's just a wall of bullish voices. And I get it. If I had held a bag of XRP for 5 years and I see Ripple IPO $40 billion on the front page of the news,
You're ordering the Lamborghini catalog.
I am absolutely ordering a catalog. It's the psychological payoff. You have to remember, for so long, holding XRP was a contrarian bet. You were fighting the SEC. You were fighting the banker coin narrative. So this IPO news just feels like the ultimate, I told you so.
And the community is just primed to believe this IPO is the catalyst, the thing that sends the token to a new all-time high.
The narrative is simple. The bell rings at the IPO, the confetti drops, and my portfolio goes vertical.
That is the expectation. But this is where we have to be the adults in the room and just ask, is there an actual mechanism for that?
Right.
Or is it just magical thinking?
Okay, so let's get into those mechanics. The big question. Does an IPO actually benefit the token price?
The short answer, yes. But, and this is a big but, strictly in the short term, and probably not for the reasons people want.
Okay, so we do get a pop.
You almost certainly get a pop, but it's an attention pop, not a structural one. I mean, think about the average investor.
Yeah.
They're not following crypto day to day, but when a company hits a $40 billion IPO, it's on CNBC, it's in the Wall Street Journal.
It passes the grandma test. My grandma calls me and asks, what is this Ripple thing I'm hearing about?
Exactly. That mainstream visibility is so powerful, it brings in what you could call retail tourism. People who aren't crypto natives, they see the headline, they recognize the brand, they open their trading app, and they buy the token because they can't buy the stock yet.
It's a sympathy play. They buy the thing that sounds like the headline.
Right. And that drives volume. It drives price. So in the immediate aftermath of the news leading right up to that bell ringing, yes, you will likely see green candles. But the source material gives a very specific and frankly kind of brutal warning about this phase.
I saw that. It was about the timeline, wasn't it?
It says, and I quote, "Every buzz fades away in a week."
1 week. That is a very short shelf life for all that euphoria.
It's really a metaphor for the news cycle. I mean, if you look at historical data for other hyped up assets, buy the rumor, sell the news is a cliche for a reason. Once the event actually happens, once the IPO is live, the mystery is gone. Speculators take their profit, they move on to the next shiny object.
And then the asset is left, what was the phrase? At the mercy of the market.
At the mercy of the market. It sounds ominous, but it's just reality. Once that hype evaporates, you are right back to fundamentals. Does the token have real utility? Is there actual buying pressure from usage? Because the buying pressure from the headline is gone.
I want to dig a bit deeper on this disconnect, because I think a lot of our listeners assume that an IPO brings in the big money. You know, institutional money. We always hear the institutions are coming.
Right.
If BlackRock or Vanguard or some massive pension fund buys Ripple stock, doesn't some of that money just naturally spill over into XRP?
That is the multi-billion-dollar question, isn't it? And the analysis we've seen suggests the answer is probably not. And to understand why, we have to get inside the head of an institutional investor.
Okay, so put me in the suit. I'm a fund manager. I have $1 billion I need to deploy. I see Ripple, 40 billion valuation. I buy the stock. What do I buy the token to?
Because you're buying two completely different asset classes. They have totally different risk profiles.
Yeah.
When you buy Ripple stock, let's just call it RIPL on the ticker, you are buying equity. You own a claim on the future cash flows of that company.
I own the business.
Okay.
I own the cash flow.
Correct. So if Ripple sells software to a bank in Japan, you get a tiny piece of that profit through company growth, maybe dividends. And crucially, you are buying a regulated security. It's cleared by the SEC. It trades on the NASDAQ. It fits right into your compliance framework.
You don't get fired for buying a regulated IPO.
Exactly. It's
Yeah.
safe. It's standard. Now look at the token. XRP is a digital asset. It's a commodity. It does not give you a claim on Ripple's profits. If Ripple makes $10 billion next year, the XRP holder does not get a dividend check.
That is a massive point. So many people forget that. Holding the token is not the same as holding shares in the company.
It is the fundamental difference.
Yeah.
And for that institutional investor in the suit, buying the token is, well, it's a compliance nightmare. It's volatile. Custody is harder. The regulatory status, while it's clearer now, it's still very distinct from a stock. So the source material says this explicitly. Stock investors are not going to invest massively in XRP just because they bought this stock.
They stay in their lane.
Stay in their lane. They want exposure to the business model, not the currency risk.
You know, it's almost like, imagine if I bought stock in an airline. I believe the airline's going to make money flying planes. That doesn't mean I want to go out and hoard 1 million frequent flyer miles.
That's a brilliant analogy. It really is. The frequent flyer miles are useful. You can use them to travel. They have value. But you buy the airline stock to get rich from the ticket sales. You don't buy the miles hoping they'll fund your retirement.
So we have these two separate pools of investors. You've got the stock pool, the suits, the institutions, the safe money, and then the crypto pool, the believers, the retail traders.
And the analysis argues that these pools, they just don't mix as much as we think they do. The source we looked at notes